Hi, good evening, ladies and gentlemen. This is Manoj Atri, real estate agent with Remax Hallmark. And I'm your host for tonight. I'm a realtor with Remax Hallmark Realty Limited. And we are now here to begin our webinar for the day. And let me touch base with our mortgage expert. And in case if you can hear us properly, just give a yes so that we know we are all hearable, and then we can take it from there. Let me take a hi from the mortgage broker. Hi, Faisal. You're mute, sir. Yes.
Hello, sir.
Hello. How are you, Faisal, sir?
I am good. How are you?
Very fine. The weather is improving.
Yes, yesterday and today was much better. I saw a lot of snow melt away.
I know. And the real estate market has become like very, very crazy.
Hot cake.
Very, very. It's a completely different market. Yes, it is like multiple offer scenarios everywhere. So that is where we are.
Mhm.
And if you have to add anything, how are you finding it out? How's in the past week or two?
Things things are amazing. Things are amazing. It's just I hear some sort of noise in the background.
Okay, let me correct it over.
Okay.
Why, if you can mute yourself, then it may be
Yeah.
at my end. Yes, it stops here. So let me figure that out. And anyway, so as we usually start with our regular format, so let's begin with the agenda of the day. Okay, so let me head over to the agenda of the day. Again, ladies and gentlemen, thank you for joining. And I really basically start with my monologue, usually, my real estate monologue. So that is where, and the thing that I'm trying to cover for today is lots of you have been calling and asking for low or zero down payment amounts. So we are going to cover that particular one, and we will also take the expertise advice on that and how realistic are we talking those particular numbers. Next, we are going to cover an article today, which is like top 10 real estate trends for 2020. And things are really moving very, very differently in this particular year. So we are going to cover what are some of the real estate trends that are going on and what you should be aware of so that you can gear yourself accordingly. We will be then touching on our webinar topic, which is renting to own versus buying and what wastes more money. So that is where we are. And the next final one is we are in constant touch with our mortgage expert, and we will seek his expertise as we go along. So he will be there with us for this duration of the webinar, and that is where we are. So let's head back to our main first one, and that is what I am going to start with, and that is what? Real estate down payment information. Okay, so let me head over there. This is what exactly it is. See, we advertise a lot for low and zero down payments, and you have so many times called us up and asked us, like, is that realistic or not? And we are going to walk you through that how these numbers work and how realistic are these numbers. And we will have our expert regularly in constant line by line on those particular ones. So let's head over to the first example here. So real estate down payment amounts. Let's start with first that the property purchase price is around $500,000. Let me also get my expert here. Faisal sir. Okay, now I'm discussing this particular amount for $500,000, and anytime you feel to like update, explain us something, feel free, please.
Absolutely.
Okay, so let's get here. we have this amount, which is like $500,000, and usually you require 5% down payment. That's around $25,000. Very simple maths. And as a first-time buyer, you can get away with 5% down. Is that right?
Yes.
Okay. Now, when we say first-time buyer, a person who has not bought a property for a very long period of time, he can also get this particular one, or he had bought and he has sold and he's back into the market again. He can also buy with 5% down. Is that right?
Absolutely.
So when we say first-time buyer, it is meaning like in case if you do not hold any other property, you can purchase a property with 5% down.
Absolutely.
So the term is slightly not that clear. First-time home buyer, like a first-time buyer, because this is the query I keep on generally getting from people. Like, okay, I used to own a property. Now we had sold it long time ago, in 10 years now. Can I go and still get with 5% down?
The answer is yes.
Okay. And CMHC fees will come into the effect. Anything whenever you are doing less than 20% down payment, CMHC fees kicks in. Is that right?
Absolutely.
So CMHC fees with 5% down payment is close to 4.1% of the purchase price. So this number comes out to be correct. Is that right?
Absolutely.
Now, I just want to, like on this particular one, I just want to ask you something else. Even with 20% down payment, we have seen sometimes CMHC is charging some fees. Is that correct or no?
That is correct. If you're going for a mortgage called as insurable. It's a technical term, and I'll break it down. So when you go 20% down, you have a choice of either going with the insurance or non-insurance.
But it is not in the interest of the buyer. It is in the interest of the institution.
It absolutely is. However, that product is built and designed for two reasons. One, to get lower interest rate, because when it is an insurable product, the rates are better. Number one. Number two is there are some properties. For instance, log home is an ideal example. Let's say there is a log home, a rural property. Client has 20% down, but no lender wants to wants to do a mortgage because it is a rural property, has septic tank, well, all those things. The insurance, CMHC insurance will insure the property, and therefore the lender will lend on that property.
So
that's another reason.
So if the interest rate is lower, that is beneficial to the buyer. Otherwise, it's of no use.
Or if it is hard to get a mortgage type property, that's when you go for 20% down insurance mortgage.
Okay, because I have seen some of the times a lender was insisting, like even you have 20% down, they still was insisting, like no, if you want it from us, you still have to get it insured, and then they had to pay around 0.65 or 0.5 or something of that sort.
Absolutely. That's an indication that the lender does not want to lend non-insured money on that property.
Okay. So it can vary from a property to property.
Absolutely.
But most of the time, if you have 20% down, you can get away with.
Yes.
Okay.
With not insurance.
Yes. So now these particular fees, so the CMHC fees will kick in. These are on the sides. We will most of the time will remain on the down payment format, but these are the side notes just to get a comprehensive idea where things are and where they're going. Closing cost approximately around 1.5% of the purchase price, so $7,500 here. So the total down payment required is around $32,500. Now, when we are saying low or zero down, then there is a product which is like a cashback up to 4%. If the credit score is good, if the credit score is 680 and above, you can avail of this particular cashback, and that comes to close to 4%. Now, so actually, how realistic are we talking here now?
4% cashback is very much available in to very much available. So it's a product I've used multiple times.
Okay. Now, my main question here is, so initially they will have to have the $32,500 and they can then get a cashback of $20,000.
Absolutely. Even if they have just the down payment, the closing cost can be financed in that 4%.
Okay, hold on here. So initially, even if they had 25 and they did not have the closing cost, it can work.
Yes.
Okay, now let's go ahead and ponder something more on this particular one. If this particular $25,000, can it be borrowed funds?
No, it cannot be.
It cannot be. So what about gifts?
There is one lender that allows gifts, but the cashback is lower. And the 4% needs to have their own funds.
Okay, so you have to have your own funds. And now when you say own funds, is it like you can use your line of credit?
Not for the cashback.
Okay, so basically
it has to be in the checking account, saving account, in a bank account for 90 days.
So basically, like, you have these funds, you can use them and then get the cash back and replenish your funds.
Yes, it's possible. You can pay your debts with the cash back. There's few things you can do with the cash back. One, you can finance your closing cost. Two, you can pay down, let's say, a car loan, a credit line of credit, a credit card, any of those credits. Those are things that can be done. You can also use cashback for moving cost or any other cost that you have related to moving.
Okay, so now this 25K can also come from RRSP.
Yes.
So that would be the only way that they can get away with. Is that right?
Or if you have it in an account, let's say if you have it in an account for 90 days, you can use that and use a cashback to cashback for the mortgage, where the cashback will pay off the credit if there is any.
So there are options where they can use their RRSP. Some lenders will allow the gift. Is that right?
Yes.
So these are two options that they will have is, so basically, see, the closing cost can come up from the, as you say, can be borrowed.
Yes.
So
closing cost can be part of cashback.
Closing cost can be part of the cashback. So basically, I mean, instead of 32, so we are down to 25, and the difference is only $10,000 or $12,000.
Yes.
Not a huge amount.
Yes.
I mean, for purchasing a property in this particular case. Do you have to want to add anything to this?
No, numbers are there.
Numbers are there. They look reasonable enough?
They look reasonable, yes.
So it is like, in case if you have close to 1 to 2%, you can get away with it.
You have to have the entire 5% in your account, but if you do the math, the end result is, if you have about 3% is what your total cost is for purchasing the property in terms of down payment. If you do the math,
you have some alternatives there. Okay.
Yes.
Now let's also, when we are on this particular down payment format, let's walk them through a different some other numbers. When you are trying to purchase a property above $500,000, so you will require 5% all the way up to $500,000. So that's $25,000. Anything above $500,000, you'll require 10%. So you'll have to come up with $10,000 for a $600,000 property. And closing cost is again close to 1.5% of the purchase price. In this case, your total amount goes to $44K and cashback is 4%. So difference is around $20,000. So these are some of the numbers that you can get away with. Now,
absolutely.
my question to you here is, uh, see, this cashback of 4%, does that have a limit? Like, okay, if the purchase price is like $1 million, still you can get 4%?
In terms of certain lenders, they have a limit up to 20, but there are lenders that will go past 20.
All the way up to what amount?
Uh, I would have to check the numbers because they have revised it. But give me 1 second.
Okay, till you are there.
While you're yes.
Yes. Okay. So now, this 10% above $500,000, does that also, is that correct information today, as per today?
Yes, has to be. Any property that is over $500,000 has to have 10% over and above $500,000.
Okay. Now, at this moment, and it also goes and stops at the $1 million mark. Is that right?
999.
Okay. So 999,
Just under
just
yes.
under $1 million. So that means any property above $1 million, you'll require 20% down payment. Is that right?
Absolutely.
So irrespective, and then when you're trying to buy $1 million property, again, is the format like for the first 500 you can get away with 5%, and for the balance 500 you require 20, or you require 20 for the whole amount?
No, you require 20 for the whole amount. If you're buying a property 1.1 million, you need 20% off the entire 1.1.
Okay, so then it doesn't work, like 5% of this, and then the rest is different.
$1 million or above properties cannot be insured.
Oh, okay. So now what happens? I mean, like, let's say, suppose you have just told me they cannot be insured. And now, I mean, will all the lenders work, or they will still require you to insure the property?
No. In fact, over $1 million and above, most lenders are out. It's only under 25 lenders that do exist that go over $1 million.
Oh, okay. And is there any other requirement? What are the income requirements on those ones?
Pretty much the same. The income ratio does go up a little bit. So you could go all the way up to 5.5 as a multiplier, sometimes even 6. It just depends on how much debt is involved and what the carrying cost of that property is. $1 million and above property taxes seem to get vary dramatically from one property to another.
Okay. So basically, like all these particular numbers, they will jive as we have now shown them here. Okay, like if you have, so basically there is what they most of the time say is, like, let's say suppose you have your parents who are like giving you the funds. Can that work?
Yes, gifts are allowed.
So gifts are basically allowed. So I mean, like, in case if your parents are giving you the funds, you can like even get the whole amount from them, and then once the cashback is there, you can pay them half off. Is that right? Is that possible?
Cashback, technically, no.
Technically,
what you do with your cashback is your business.
Okay.
But if it's a gift, it's a gift.
It's a gift. Okay. So, but and you can take money from RRSP. You can take money from family or friends. Is that right? Or
family only, close
family only, and that can come as a form of a gift.
Yes.
And is there any other way that RRSP gift, any other format that you can?
There are lenders that will allow 5% some borrowed amount from a line of credit. As long as the
interesting. And
as long as the
amount?
ratios work, but then the cashback does not. Cashback is not an option.
Oh, okay. So, but you have the line of credit as an option there.
Yes. Not everything can come from line of credit. Some of it can.
When you say some, means 1%, 2%, or
it depends on the strength of the file.
Okay.
I have seen up to 3% allowed.
Oh, okay. So there are options on the table.
There are options on the table. Yes.
It is not that when we say like you can get low or zero down, it does work. It is not that it doesn't work.
It does work. It just has to work with the numbers, and overall the insurer has to be comfortable with the strength of the file. What I mean by that is someone who, every file has its own strength, and the strength of the file has to be there.
Okay. So basically, just reiterating this one, let's say suppose you take a $500,000 property, and you get a gift from your family for $25,000, and the closing cost is covered by the cashback. So basically, there is an option that you can get away with zero down.
Absolutely.
It is not that it cannot be done.
It can be done.
Okay. So that is the gist of it. Like these are the breakdowns on the down payment format, and CMHC fees comes in over, and you will have to work with that because that's a huge chunk that is there. Do you want to add anything else that I've missed out?
No. I think we're good.
Okay. Let's head over to our next topic, which is like we are going to cover are the top 10 real estate trends for 2020. Let's head over there. And Faisal, this is an interesting because the market is so much changing on a regular basis that we will have to now figure out some of the things that are going on in the market, and that is why I picked up this particular topic for discussion. Okay, this article is by the Cochrane Times Post by Linda White, and she had published it on 11th of February of this year. So let's review this top 10 real estate trends for 2020. Most of the article I figured was had some info on Ottawa, but let's see how it reflects to our city here.
The numbers are only worse here.
True. How the 2020 real estate market unfolds is anybody's guess. Absolutely correct. Experts are seeing change reflect changing expectation, preferences, and behavior in the market. Despite the modest economic growth of 1% year over year in 2019, Canada has a record population growth of 560,000 nationally. Wow, that's a huge number. And a current unemployment rate of 5.2%, the lowest level in more than 15 years. Wow. These factors are expected to benefit 2020 real estate landscape. Now, I did not understand this particular part. How is it expected to benefit? Half of the people cannot buy any properties. Go ahead, Faisal.
Well, you look at real estate. It's at the end of the day, it's strong economics of supply and demand. Yes, you're right that half of the clients cannot seem to qualify. However, there are individuals that do join forces. That adds pressure to the entire system. There are individuals that now that because the unemployment rates are low, of course, that adds to the rental market.
True.
Therefore, rental market would be stronger. There's a whole lot behind the scene, but when unemployment rate is low and your population has grown that far, all that will develop pressure on the real estate. There are clients I've had in last few months where parents are pretty much putting the entire down payment for their children just so they can have their children out of their home.
The reason I'm picking up on this particular one is like benefiting 2020 real estate landscape is from our point of view or any one expert point of view, it should be that the market should remain balanced. The supply and demand should be in like a control. And because now let's say suppose the real estate market is going high because supply is not there.
Mm-hmm.
There is tremendous growth or immigration to Canada and Ontario and Toronto in general, and the everything else, the stress, the interest rates are holding there. But the main thing here is, if you have seen real estate in the past 10 or 15 years, it goes up and down, but at this moment it's just climbing. And when something will go down, then there will be a tremendously because see, you enjoy when you are able to make money from real estate and your house as an ATM.
Mm-hmm.
But that scenario, I don't think so, is going to last for long.
It's hard to predict the future. However, there's always assumptions that all the growth in the real estate will come down at some point. We did see some drop in real estate from 2017, a little drop in 2018, a little climb in 2019. As per statistics and everything else that I'm seeing, 2020 is expected to be a stronger market, like 2017, maybe even more.
Absolutely.
That's what CMHC. Sorry, I just cut you off. That's what CMHC has said.
Okay, let's head over to the complete article there. One is the first point that they are revisiting the stress test. Now, potential buyers may be returning to the real estate market after sitting on the sideline following the introduction of the mortgage stress test 2 years ago. Yes, let's ponder on this one, because the stress test, some changes had come last week, I think so, last week or 10 days ago.
Absolutely.
And what are they, if you can walk us through
that? So the stress test clause was interest rate, the mortgage interest rate, plus 2%, or 2 years ago was 5 benchmark rate, whichever is higher. So the benchmark rate started as 5.39. It is right now at 5.19. But let's just say a very good interest rate mortgage is, let's just say 279. I'm just using a rough example here. 2.79 plus 2% is 4.79.
Mm-hmm.
As per old stress test, you would have to, we as mortgage brokers would have to use 5.19 to qualify that client.
Okay.
Because 4.79 is less than 5.19, and the clause says higher of the two.
Okay.
Now, with the stress test revision,
mm-hmm.
we are allowed to use 4.79.
Oh, okay. So there is more qualification. Is that correct?
Approximately, if you do the numbers, and these are just approximate numbers, there's 5% increase in purchase price with the new stress test. Anywhere between 4 and 5% increase.
Okay. So they're revisiting the stress test. Now, do you anticipate they'll be going for more or no?
It took this long to have this change done. I don't expect another change anytime soon.
But it is like, let's say suppose someone was qualified for $500,000, so now they can get qualified for 525?
520 to 525, somewhere in between. Purchase price.
Okay. So there has been slightly giving a boost to that particular one.
Yes.
Okay. Now, the article says Royal LePage also recommends a regional approach to the mortgage stress test if the federal government goes ahead with the changes this year. Whereas the Canadian CREA has also expressed concerns about the stress test. Okay. So basically we have seen some changes here, that it is you can get qualified for slightly 4 to 5% more than earlier. Modest rise in home prices. Their healthy price increases are expected this year, with Remax Housing Report estimating a 3.7% increase in average residential sale price, and the average prices are these days around close to $670,000. Now, there is a new interest from developers who are entering the market and building luxury condos for those in search of a different lifestyle and type of home ownership. So, if you can see, these are the two things that are going on in the market. One is 3.7% as per Remax 2020 housing market outlook. And they are saying they're now trying to go for, instead of single family, going for luxury condos. And I've seen numerous ones which are like coming in the downtown core.
Luxury condos, condos have taken a lot of, condos are quite attractive to clients at this moment for various reasons. One is if I give you a light from the mortgage side, the condo fees, only 50% has to be calculated.
Oh, okay.
Okay, so a detached house can get, if we were to take the maintenance, if there is a maintenance, and usually detached homes don't have one, but if they did have a maintenance, they would have to be used 100%. Here, because it is used 50%, you can qualify for a little bit higher number.
Sure.
Number one. Number two is the way our lifestyles are, and if your jobs are downtown Toronto or somewhere in the urban area, the transit system doesn't allow you to live too far from where you work.
Yeah, it is too much of time wastage.
Yes. And I used to take transit for some time, and it used to take hour and a half one way.
Sure. So basically two things are coming from that one is the 3.7% estimated growth in the prices, and luxury condos coming in the market. Now, let's see here. Softening demand for single family housing. That's what we were discussing, in part due to lack of move-up buyers. I have seen this one very, very in the market, that those who own a property, few years ago, they used to sell that one and move to a different property and hire like a trade up or something. But now no one is doing that quite a lot, because they may be able to get more for their property, but then they will be stuck up with the new property because the supply is not there. So they're getting stuck up in this situation.
Well, because the market is so strong, selling is selling is possible.
Oh, easy.
Easy.
It's a seller's market today.
However, the same seller is a buyer once they sell.
Yes.
And that's the unknown.
That is the scary part.
That's the scary part. So when that is a scary part, of course, it holds back the clients.
Tremendously. So that's why softening demand for single family housing. People are also trying to figure it out, okay, in this particular price range. Next part, that is larger condo suites. Yes, this also you have seen that, because now they earlier they were making those pigeonholes. Now they are going slightly higher because there is a demand for that.
See, when clients are not doing move-ups, most times when you move into a condo, you're moving in from an apartment.
Yeah.
Which means you have similar size, similar square footage, and therefore the stuff that you move in with most times works in the condo. However, as time goes, you want a bigger, you collect more stuff, your kids grow, you are growing, and you collect more stuff, and therefore you do need a bigger space. Therefore, and if you're not moving, you might as well have a larger condo, which is what the developers are now looking at, because
They are catering to
yes,
that. Yes,
if there is no move up, which means the client is going to be in that unit for longer period, which means they will need more space.
they will. They will. Even when the kids have moved out, and
Hmm.
now you are now trying to go back to a condo, they
Hmm.
are liking those ones which are bigger in sizes, not have some breathing space there, instead of like a very tight spaces. I mean, where do you what do you exactly do there? Okay, next one is co-living. Now this is a different kind of a co-living that they are trying to explain. By blending features of apartments, dorm rooms, and hotels, co-living accommodations give residents their own spaces with common living areas at a more affordable prices. Like we used to have in our university days,
Hmm.
you used to have a room, and then you have used to have different other facilities. That kind of a co-living is also the trend that may come over down the road.
Yes, that has already started.
That has
Co-
absolutely.
there I've done cohabitation mortgages, um, and it seems to, so far, they're working.
No, you're right. But this cohabiting and co-living, the word may be the similar, but they are in a different way. Cohabiting means like you are sharing the place with someone else. But here, the common spaces are,
Oh, I see.
the common spaces are coming into effect. That means I'll read the next part, then you will understand. They're coming up with, instead of even the shoppings. Let's go to the second part and then brief you on that particular one. Purpose, okay, probably not this one, but the next one is the ProTech that takes care of this. But let me walk you through on this particular one. See, what happens is the sizes, because now everyone is trying to live in condos, but they are giving more amenities. The amenities are spreading like crazy. You have terraces, you have guest rooms, you have gym, you have many other facilities which are you not used to see in the older condos, which are coming as a trend here. That is what the author meant by co-living and sharing common spaces like.
Okay.
Let's go to the next one, which is purpose-built rentals. Many baby boomers looking to downsize are choosing to rent, as are some millennials who find it attractive and potentially more affordable alternatives to buying a home. Wow. So this is another trend that is going on. Like after you are downsizing, instead of going back to purchasing a condo, they're trying to go for a rental. Interesting trend by the author. And it looks more viable, though the rental rates may make them think twice. Rental is not cheap these days. Very difficult to get rentals. And the main thing, go ahead with this, and then I'll explain you one more part on the rentals.
Rentals are expensive, and of course you're paying someone else's mortgage. However, every client has their own, and being a baby boomer, you're in your retirement ages or close to. So they have a little bit of a different outlook as to what they want to do, and that may be something that may attract them towards rental. That's the only thing I can figure out.
These days, the point I was wanting to make about the rental is, if you pick up a rental and even you're a good renter, the landlords are getting greedy because the rents are rising so sharply they can get double the amount from the time 5 years ago that they were renting it out.
Absolutely.
And that is so even your rental, you may prefer to go for rental, you may be able to afford rental, but there is no security. Any other day they can come up with some kind of an excuse, get you evicted, and you're back to square one.
Yeah.
Because you chose rentals so that you can at least live there for a few number of years, but that may not be the case. That's why that particular part is fairly scary there. Okay, now there's still debate in Toronto about where in the city and under what condition it makes sense to build rental housing. Now, I don't have much info on rental housing, but any idea on that particular one? Are we building a lot of rentals here?
5 years ago, I never saw rental properties being built, rental buildings. But recently, I've seen two of them.
Yeah,
One of
I have
them
heard
is
quite
at
a lot. Yes.
one of them is Victoria Park, Shepherd and 404 area,
Okay.
luxury rental.
Oh wow.
And there is another one that I've seen in Durham.
Okay. So I've heard like a lot of those particular buildings are being done as rental apartment because they're lucrative.
Yeah.
They're very, very lucrative these days. Okay. Now let's head over to the next one, which is prop tech. This is an interesting one. It is intersection of technology and real estate. Smart home and smart building applications aimed at energy efficiency, trying typically by embedding sensors powered by the Internet of Things into their system. Company that is looking at designing a residential development with no garages to account for a future that includes autonomous vehicles. Now, I am not much aware of this particular trend, but they're coming up with ideas here. Matching real estate with technology and future that includes autonomous vehicle. How would that work?
It's hard to believe, but
I know
there's a lot of technology out there today that was hard to believe 10 years ago.
I mean, I have seen a lot of condos downtown which are like without parkings, which comes with like very limited parking spaces. And people prefer those particular buildings who live nearby and they walk or take transit.
Absolutely.
And let's see, I mean, like how does this trend takes shape with no garages to account for a future that includes autonomous vehicle. Wow. Okay. Let's see how that plays out. Sellers market. Royal LePage is predicting a vibrant spring real estate market. Absolutely. As the trend I am seeing, it is going crazy. Though Ontario is reportedly experiencing its busiest construction season ever, housing supply still falls short of the demands of the province's rapidly growing population. Whereas Remax notes, that means buyers may face bidding wars for the most desirable property types and neighborhoods. This is the biggest scary part that is going on. And we had seen bidding wars on most of the properties, but now we are seeing bidding wars on all the properties, nearly all the properties. It's a very different trend going on in the market. Supply is not there, sir.
Well, supply is not there for a reason, because the seller who is supplying the real estate needs to buy something 9 out of 10 times.
Yep.
And when you're uncertain about what you can buy, the supply will be low, and therefore demand will outstrip.
Airbnb also has messed up quite a lot.
It has disrupted the market just like Uber
And Lyft, yes, absolutely. Now, let's head over to the next one, which is low interest rates. Bank of Canada target rate and bank prime rates have been paused since 2018 October. But when rates change resume, most analysts expect rates will drop, likely in response to an economic slowdown. So that means we are expecting low interest rates for the near future. Influence of foreign buyers. Toronto 2019 market proved buoyant, finding its footing in the second part of the year and maintaining its position as a seller market. Yes, it's a seller market today. This was driven by a strong economy and healthy population growth, as well as domestic and foreign immigration. Okay, now, interesting here. The largest international buyer segments were seen coming to Toronto from China, Iran, and Russia. Now, how will this play? Because coronavirus is taking its tangles in various other countries.
Coronavirus. What I see is we have political stability. I mean, the virus is just one more reason to existing reasons of why foreign buyers are interested in Canadian real estate. At the end of the day, we have political stability. Our dollar is strong. And we have slow and steady growth, which is what is very desirable by foreign investors.
True.
And that is where
things are like, influence of a foreign buyers is not going down. I don't see it diminishing.
They added some sort of non-use home sort of a tax in Vancouver.
Vacant tax and
vacancy
foreign tax also.
Yes. I mean, that did deter the buyers a little bit.
And they came over to Toronto then.
Exactly. They went into a different market.
They went into a different market. They
now
never stopped.
Imagine Ontario was to put something of that sort, they would probably go somewhere else.
Yes, absolutely. So now, this article at its conclusion says city prices to increase at a quicker pace. But obviously, we are in the thick of it at this moment. And they say by 4 to 7%. So this is what is expected. And suburban prices rise by 3 to 5%. I think so. These numbers are modest. At this moment, it is going way beyond these numbers.
Absolutely.
They are not taking it easy here, sir.
No.
They are going quite drastically higher. Okay. Now, that concludes the article for us, and let's take over to the webinar topic of the day, and let's see if I can walk them through that particular topic. Ladies and gentlemen, we are here to our webinar topic, renting to own versus buying, what wastes more money, and let's guide you with some of the information here. Now, before I begin, I needed to just walk a few of the people who are new to the webinars and explain that in the term, what exactly is rent to own homes. In simple terms or in layman terms, rent to own is that you're not buying today, you are buying tomorrow. And this tomorrow can be anywhere from 1 to 5 years. Most of the time, I mean, the investors prefer 1 to 3 years. They don't want to even go all the way up to 5 years, but that is what they will go for. And we, at this moment, find very difficult for investors to go beyond the 5-year term. Second, in this rent to own concept or the format, you have to understand that at a certain stage, you have to own the property. That means when you have to own the property, that means you have to qualify for a mortgage. So that has to be understood. You will have to buy the property after the end of the term. So that is where it has to be understood. So these are some of the two things that are there. Now, what is a rent to own homes program? And I generally call it a worst case scenario. Why do I call it? And I'll explain you that particular part to you. Let's say suppose you cannot procure a mortgage. So you have issues with your credit, issues with the income, and you're not able to procure a mortgage. And second thing is, somehow you have even goofed up your renting. So that means, or you're in a situation where you are not able to rent. What options are there on the table? And that is when you can look into rent to own. And The reason I'm explaining you these particular things is you have to comprehend a couple of things in here, that rent to own is a worst case scenario. It is a very costly program and it should be your last alternative. So once you have understood these particular things, then act into it, because otherwise you'll be spending 2-3 months trying to go through the details of this particular program and then say, oh, it's a very costly program. That is the reason we are explaining it to you right up front. It's a very costly program. It's a worst, we are addressing the worst case scenario by the rent to own home program. So that is what exactly I call it as a worst case scenario, and we have an option for that particular thing. Now let's discuss some of this particular format, rent to own versus buying, and that is what we are trying to see, which one wastes more money. Now before we go and dwell which one makes more money, let's explain you the difference between rent to own versus buying. And this is, make sure you do your homework, understand this particular format before you indulge. And the biggest difference is the credit score. So everything else will remain the same except the credit score. That means if your credit is bad, you are doing rent to own to repair your credit till the time you're able to repair the credit and procure a mortgage. That is the only element that is different. Rest, everything else is the same. And you can always subscribe to my newsletters, and you can download this particular book for free, which will give you the A to Z of rent to own homes. There is no difference in the income format. So whether you are trying to do rent to own or whether you're trying to do the purchase, the income requirements remain the same. The down payment requirement remains the same. Even in fact, if your credit is good, we may be able to get you a cashback and lower your down payment, whereas in a rent to own, you have to come up with the entire down payment on your own. There is no help that you can get here because the cashback format is not there, because you haven't procured a mortgage here. And now the last and the challenge, I have to walk you through this particular one, is even if you find, whether you're trying to buy or whether you're trying to rent to own, there is one challenge which is there in the market, is finding a property in your price range. So that has also come into the effect, and I just wanted to highlight you this particular one before I go into the next one. Faisal sir, do you want to add anything to it, sir?
Finding a property in your price range, big question. A question that did not exist in 2018, 2019.
No, even till last year
Today,
we were struggling. We were okay. This has become a major issue today. Okay, let me continue before we lose track of the time there. Now, before I go ahead and walk you through the other format, let me give you a difference between rent to own versus buying. Okay, let's take an example here that you're trying to buy a rental for between $2,000 to $2,300. Slightly okay, you still can find properties for renting for $2,000 per month. And let's say suppose you have a choice, take a rental for $2,000 per month or pick up a property for $500,000, and we are assuming that the utilities to be $300 per month and taxes to be $300 per month. Let's see how the numbers crunch. Okay, the numbers are, we are taking the lower rental amounts, and let's say suppose the renting amount is $2,000 per month. Utilities and there is nothing extra, everything is included in this particular rental amount. So you are paying close to $24,000 per year. Now, let's say suppose you go and buy a property for $500,000. Your mortgage amount is going to be $2,400. Your utilities and insurance, let's say $300, and your taxes to be $300. I have slightly rounded these ones just to give you an explanation here. and your per month amount may be $3,000 per month. Now, if by chance you are able to rent out a portion of your house and get almost close to $1,000 per month, you are basically matching the rental amount. So this is the and that is where you can almost come as rent free per year. So that is the difference between renting and buying. Now let's review this particular one. So basically in renting, you have lost $24,000 per year. It's not coming back, it's just gone. Whereas if this house appreciates by another 5% per year, so the next year is 25 to 525, so you have basically made profit of $1,000 plus you are rent free. So that is the advantage of purchasing the property. Now you may have some issues with buying. Your credit may be bruised, your income may not reach there to qualify for a property. You require around 4 times the income for a condo and 4.5 times the income for a freehold property. And you may lack on some of those deposits, and we just discussed those particular deposits, and you may have some options and alternatives to those particular ones. Now you may not be comfortable renting, so you may look into buying options there. And I have many times said buying is a forced saving. It is, you're not losing money, because try to visualize you are saving in a bank account. So even if sometimes you're paying slightly higher, it is like a forced saving. So have a consideration on that particular part. And second, this is a very important here. You can also, like, let's say suppose you are struggling, you can join hands forces with friends, relatives, and do a co-ownership, and you can procure a property. You can live there for as long as you want. You do not have a landlord on your head and coming and saying, no, I want my property, you need to get out from here. So that is some of the things that you can look into. Now I'm going to go into the next one, which is rent to own versus buying, as an example. So let's take the experts' feedback on this. Between renting and buying, you're mute. Yes.
If you can buy, of course, buying is a better option. And I would like to say that our audience, if you don't think you have enough, still let the experts decide. You should not be discouraged. Oh, my credit score is not so much. I don't have enough down payment. My income may not be enough. These things, of course, we say this on the video here, but not to get discouraged, because we have many ways to make things work. So
absolutely,
when you look at renting versus buying, we try our very best to get you a home, so you can start collecting your equity.
Absolutely. Give a call to your professionals, and yes, they will have some options for you there. Okay, now regular buying amounts. Let's say suppose you're buying a property for $500,000, 5% down payment, that's $25,000. Approximate closing costs, so that's around, and you as a first-time buyer, you will get some discount. So we have added slightly less there, and let's say suppose your total amount comes to around $31,000. Now, in per month amounts, I am assuming is close to $3,000 per month, including mortgage for $2,300, utilities $300, taxes $300, home insurance $100, and the property, let's just say, appreciates 5% plus per year. So the property value after 5 years should be close to $630,000, and your mortgage balance after 5 years around close to $430,000. So basically after 5 years you are going and procuring a new mortgage for around $430,000. These numbers are very interesting, so pay close attention to this. So the total difference is close to $200,000 as equity here. So this is when you were trying to do a regular purchase. Now let's walk you through if you were trying to do the same format in a rent-to-own scenario. We take the same example, but now we are trying to do a rent-to-own $500,000 property purchase. Again, let's go through. So we are trying to keep the numbers same. You generally require between 5 and 7% down payments for doing renting to own. So now let's say suppose you have a 6% down payment. The lawyer fees is 1%. The total amount comes to the same amount as $31,000, and your per month amounts are slightly higher in this particular case. That means instead of $3,000, they're $3,500, whereas the $500 goes towards your additional down payment. So rental could be $2,600, utilities could be $300, and this $500 is going towards your additional down payment. Assuming that the property appreciates 5%, we remain on the same format, and the option purchase price after 5 years. So now you bought this particular property in a rent-to-own format. You have to now buy this particular property and procure a mortgage of $630,000. So this is where it gets interesting. After down payment, you had given $30,000, so you may have to procure a mortgage of $600 instead of $630. So the total difference that has been paid, that means now you have to procure a property for $600. Had you purchased it, the value would have been $430. So now you have overpaid by $170,000 in a rent-to-own option. Okay, let's go ahead. So that means we have already shown you in the renting to own versus buying, the buying is making more sense than the rent to own. But now let's look into one more aspect of it. Let's try to see both these numbers side by side. Okay, here is what we just discussed, whereas 630 minus the 430, you were trying to do a regular purchase and you have $200,000 as your equity. In a rent to own, you had lost $170,000 as equity had you purchased the property. But there is one more option that has to be seen. If by chance you were renting at $3,000 per month, you would have had paid $180,000. So basically, whether it is rent or rent to own, both those numbers are similar. So buying should be your first option rather than renting or rent to own. So renting and rent to own both remain on the same platform, and buying is on a very higher number. You've already seen that you would have had lost $180,000 in a rental in 5 years, and in a rent to own you have lost $170,000. So basically buying is more preferable than rent to own or renting. So that concludes us within, like I'm almost on time for our 1 hour webinar, and that is the reason why we call our program as a smart rent to own program, because this is where we walk you through all the options on the table. We walk you through all the things that are involved. What are your pros, what are your cons, and give you the whole 9 yards of the program so that you can make an informed decision. So with that, it brings us to the end of this particular format, and I have some other rent to own webinars videos. You can click on those ones and you can have a look at this particular one, and that will bring us to the end of this particular one. And before we go, let me take you ahead with some of the other stuff. I think so our mortgage expert has left, and let me guide you through some of his information so you can be in touch with him. He's an expert there. and will be able to assist you. He is with Dominion Lending, and you can go to his website, which is called faisalgarcia.com, and you can be in touch with him there. He is also an expert on credit repair, and his website is creditrepairnow.ca, where he charges a small fee where he can get your credit repair done, and he has done wonders there. I'll also take the opportunity to walk you through some of my information, and this is one of the newsletters that I do on a regular daily basis, where you can come and subscribe. It is called gta-news.manojatri.ca. It is on lots of these descriptions, and everywhere you will find in my format, so you should be able to get a hold of this particular page, where I curate 8 to 10 articles on a daily basis and email it to you regularly on a daily basis, so that you come to know what exactly is going on in the market and how you can take benefit from there. So those are you can come here and subscribe on this particular page, and you should be able to go through these particular articles on a regular daily basis. This is my main website, which is called manojatri.com, and this is the webinar page where you must have come and registered for the webinar. And here you can do some free online home search. You can go to manojatri.com and you can be in touch with most of the information that is here. I have investors who buy any GTA area, any conditions with me, so you are more than welcome to give me an update on that one. I'll be more than happy to put that together for you. Power of sale listings. You may be wanting to know some of the latest bank foreclosure listings. I have access to all of them as a real estate agent, and if you can update your information, complete info, I'll be able to send you power of sale and GTA listings. Zero down and cashback program. We took some of those particular information today. You're more than welcome to come and join, give me your scenario, and I'll be able to help you on that. We can also assist you with the rent to own program. I have investors who are doing very good, and I will be more than happy to put them in touch with you so that you can do your rent to own options programs there. We on alternate Mondays between 7 and 8 p.m. we do our smart rent to own homes webinars. You're more than welcome to join us, and feel free to post your queries and I'll be more than happy to answer those particular queries whenever and they require. Feel free again, how much is my house worth instantly? I'll be more than happy to give you the value comparative market analysis of your property, and we can take it from there. So this, ladies and gentlemen, will bring us to the conclusion of the webinar today. Thank you again for joining, and we will see you next Monday. And feel free to post all your queries, concerns, and I'll be happy to answer those particular things, and as much expertise you require, we'll be able to guide you with that. Wonderful. Thank you again, sir. Thank you for joining. Good night. Bye for now.